Imagine waking up to $1,000 in your bank account every month without lifting a finger. Sounds too good to be true, right? Well, in this video, I'm going to show you how to make that dream a reality through dividend growth investing in 6 easy steps. Step 1, educate yourself. Podcasts, books, YouTube videos, whatever media you prefer, there is a ton of information out there so you can develop a plan for where to start on your investing journey. In the description of this video is a list of some of my favorite books, so go check them out. Step 2, make sure you have a solid budget in place that allows you to not only pay your bills and live your best life, but for you to invest. Because ultimately, your investments are going to buy back your time, and your money is going to make you more money. So create a reasonable budget and find some money to invest. Step 3, open a brokerage account. Fidelity, Vanguard, Schwab, those are amongst the biggest players. I've got a few Fidelity accounts, a small Schwab account, and I also have an M1 Finance account. Because spending time with my people and my dogs is most important to me, I want to automate as much of my life, my budget, my savings, and investing as I can. And M1 Finance does that for me. I set up daily recurrent deposits of $44 a day, and M1 automatically invests that deposit based on the allocations I've established for myself. For more, you can take a peek at some of my M1 Finance videos, which I'll link in the comments below. But do your research and find a platform that you're comfortable with that you can navigate easily. Step number 4 is fund your brokerage. Based on your budget, determine what you can afford to invest each week or each month and automate it. Do what you can afford. It doesn't matter if it's $50 a month or $100 a month. You'll see shortly what even small investments can grow into over time. But you do need time. So seriously, finish watching this video and get to it because the dividend snowball takes some time. Step number 5 is pick something to invest in. And we're going to run through a few different investing options. The first being a money market. There are money markets right now that you can set up in a brokerage that are paying some of them 5%. 5%! My Fidelity SPAX account is currently sitting at 4.98%, which is where I've got my emergency fund housed. So my money just sitting there is making money each month. Another investment option is to purchase an exchange-traded fund or an ETF. If you're new to investing and scared to make a single stock purchase, look at the ETF options. They're essentially a basket of stocks, creating diversification and reducing your risk. I've done a few videos on ETFs that you might find helpful, and I'll also link those in the comments below. But some examples and fan favorites among dividend investing community are VOO, which is essentially buying the S&P 500, SCHD, which has a cult following and follows the Dow Jones U.S. Dividend 100 Index. Then there are other ETFs like DGRO, SCHG. If you go in this direction, you can use a platform like Seeking Alpha to do your research, where you can see the top 10 holdings to get an idea of the companies contained within the ETF. And if you want more information, you can actually go to the ETF's website and get all of the holdings that are contained within. Here I am on SCHD, and you can see its top 10, and there are currently 104 holdings in this ETF. Your other option is single stocks. If you choose to go in this direction, just do your research. Invest in something that's familiar to you with a company structure that you understand. And finally, step number 6. And this is where we get to watch our money grow. So we're going to do 2 things today. First, I want to show you a basic compounding calculator, and then I'll share a dividend calculator so you can see the difference between the two. First, let's look at the compounding calculator. This one is available through investor.gov, and it's super simple to use. Let's say you've made it through the 5 steps above, and you have $100 in your budget that you can allocate to investing. If you add $100 monthly for 30 years, with that estimated interest rate of 5%, in 30 years, you will have contributed $36,000, but at the end of that time frame, with that 5% interest rate, you'll now have $80,158.81. Now let's change the parameters and say you were able to find $200. In that scenario, over 30 years, you would have contributed $72,000 which would have grown into $160,317.62. Are you guys picking up what I'm putting down here? Okay, now we're going to talk about the effect of compounding as it relates to dividend investing, and we're going to use the same two scenarios. First, we start with our initial investment of $100. We still contribute $100 a month, which equates to $1,200 a year. But because we're buying dividend-producing stocks, we need to add a few more parameters. For one, capital appreciation. Has the value of the stock gone up? Let's assume a 5% share price appreciation. Now, because you're a dividend growth investor, you're buying companies or ETFs with solid growth rates, meaning that each year that board of directors gets together and they raise the dividend for its shareholders. I like a healthy dividend growth rate, so we're going to assume a 13% dividend growth rate and a current yield of 3.5%, which would give you a Chowder score of 16.5. And if you haven't heard of Chowder yet, I'm going to link a video for you to check it out, something I just learned about, and it's pretty interesting. In this scenario, we are reinvesting any dividends that we receive, which is what is going to truly allow us to build the dividend snowball. At year 5, we're receiving $344 in dividends each year. By year 10, we're receiving $1,322 in dividends each year. By year 15, we are receiving $4,266 a year. And somewhere between years 19 and 20 is where we're going to hit that tipping point of $12,000 in dividends earned each year, which would equate to $1,000 a month. Now let's see what happens if we change that investment each year to $200 a month with an annual deposit of $2,400 a month. We're going to keep the rest of the parameters the same, and you'll see at year 5, we're receiving $688 in dividend income. By year 10, we're up to $2,644. By year 15, we're receiving $8,533. And between year 16 and 17, we're going to hit that $12,000 mark, again, getting us to that $1,000 in dividend income each month. This means we still have the principal from our initial investment and any appreciation that we've seen. We aren't drawing down on our nest egg each year because our money has continued to make us money. And we won't have to worry about share price fluctuations because those individual holdings are going to pay us our dividends each month. And this, my friends, is how generational wealth is created. Now, the example I used when calculating the dividend growth rate is the ETF with the cult following, SCHD, the Schwab US Dividend Equity ETF, which you'll see here has a share price appreciation in the last 10 years of 103.07%. If we pop on over to the Dividends tab, you'll see that 5-year dividend growth rate of 13.69%. And you'll also see the dividend yield in the trailing 12 months is actually 3.72%, and we figured on 3.5. So I'm going to ask you, can you find $100 or $200 each month to invest? Imagine the possibilities if you could invest a little bit more each month. And the more time you have ahead of you, the larger the final value of your portfolio and the larger your dividend snowball that pays you each month. As you ponder how you're going to find more money to invest each month, go and take a peek at this video next.